Hello everyone. Today we are gonna solve the problem solving part of chapter number 10. So here in this part, we are gonna forecast financial statement. In finance, we call it pro forma financial statement. And then we are gonna estimate the firm value and then stock price using free cash flow to the firm. In the process, we are gonna also run sensitivity analysis and simulation for our estimated net profit. All right, then let us start. You can see here, this is the financial statement for microdrive for the year 2021. And with this financial statement, we get financial information for the last 2 years. I mean, for the year 2020 and 2021. All right. And then here we have the assumptions. Our assumptions is related to the operations, capital structure, cost of capital, and target dividend policy. Now, based on all of these assumptions, we are going to now forecast financial statement. The first step here is to estimate additional financing need. And then we are going to calculate free cash flow to the firm. Then from free cash flow to the firm, we are going to get the value of operations. Then from value of operations, we are going to get stock price. Then we are going to complete the pro forma financial statement. Then we are going to run some sensitivity test and simulation. All right, then let us now implement the plan we have. So first, let us just copy our assumptions related to operations from our assumption table. Here we got all of our assumptions related to operations. All right, now let us now forecast our operating items. First, let us copy our net sales from the previous financial statements. Also, let us copy our cash, accounts receivable, inventories, net PPE, accounts payable, and accruals from the current financial statement. So cash, accounts receivables, then inventories, then net PPE, accounts payables, accruals, the same way. Let us also copy our operating expenses. First, cost of goods sold, then depreciation, other operating expenses, we don't have any information related to cost of strategic initiatives, so let us just keep it blank. Now let us calculate earnings before interest and tax. So it is sales minus the sum of all the operating expense items. Then net operating profit after tax. So EBIT times 1 minus tax rate. All right. Now, let us forecast all of these items. Sales. So our sales are expected to grow at 10% in the year 2022, at 8% in 2023, at 7% at 2020 in 2024, at 5% in 2025, and then at 5% in the year 2026, and then this 5% sales growth rate is expected to continue forever. So you can see we are growing our sales account by the expected growth rate in every year. All right, then our cash is expected to be 2% of total sales every single year. Then our inventories here, our accounts receivables here is expected to be 10% of total sales, and then our inventories is expected to be 20% of total sales, and then our net PPE is expected to be 40% of total sales, and then our accounts payables is expected to be 4% of total sales, and then our accruals is expected to be 8% of total sales. Drag it down to just apply the same concept in every single year. Next, cost of goods sold. So cost of goods sold is expected to be 78% of total sales. Depreciation is expected to be 10% of net PPE, and then other operating expenses is expected to be 10% of total sales. And then let us apply the assumptions for the other years in the same way. Okay, now we got our forecasted EBIT, our net operating profit after taxes. Also, we know our operating assets and operating liabilities in the forecasted years. Now we are going to estimate our net operating working capital. So net operating working capital is equal to sum of, it is the difference between the total on operating assets and total operating liabilities. And total net operating capital is net operating working capital plus net PPE now free cash flow to the firm. So it is the difference between net operating profit after tax and the changes in net operating capital. So net operating profit minus changes in net operating capital. All right, so now we got our forecasted free cash flow to the firm starting from the year 2022. All right, now let us calculate our target weighted average cost of capital. So here, weight for debt is 4%. Cost of short-term debt is 8%. Then adjust it for the tax rate. minus tax rate, then plus wait for preferred stock, and then preferred stock, cost of preferred stock adjusted for the flotation cost, then wait for common stock, and then cost of equity, drag it all the way down to get weighted average cost of capital for all the other years. Then operating ratio, which is NOPAT divided by total sales. Then capital ratio, total operating capital by sales. Total operating capital by sales, and then return on invested capital. So it is net operating profit after tax over total net operating capital. Then growth in free cash flow to the firm. Right. Now, in this particular problem, you can see here, we got our free cash flow to the firm starting from 2022 to 2026. And then our free cash flow in the year 2026 is expected to grow at the rate of the sales growth rate. And then our terminal sales growth rate is 5%. If we check, our terminal sales growth rate is 5%. That is exactly the sales growth rate we have. That is exactly the free cash flow to the firm growth rate we have in the year 2026. So this free cash flow to the firm in the year 2026 is expected to grow at this 5% rate forever. All right, then what we are going to do here? So here we have our free cash flow to the firm in the year 2026. Then you are going to grow it by the terminal growth rate, and then you're going to apply the constant growth formula to get your terminal value. So here your denominator here is the difference between weighted average cost of capital and the terminal growth rate. Now here, remember, you are using free cash flow to the firm in the year 2027. How you get it? You are growing free cash flow to the firm in the year 2026 by the terminal growth rate, then you get a free cash flow to the firm in the year 2027. So the value you're going to get based on the constant growth model will be 1 year earlier. That means you're going to get value in the year 2026. Is it clear? All right, then let us now apply. So equal our free cash flow to the firm, then times 1 plus growth rate divided by weighted average cost of capital minus growth rate. Right. Now let us, so this is the value we get in the year 2026. Now we are going to discount it back to the year 2021. So you can see here, your free cash flow to the firm value is now here. Thus, let me just clarify. So the terminal value you get based on free cash flow to the firm is now in the year 2026. But our current year is 2021. So we need to discount our terminal value from the year 2026 to the year 2021. Now, for how many years we now need to discount? we need discount for the difference in 2026 and 2021. That means we need to discount here for 5 years. Equal your terminal value, then discount it by the weighted average cost of capital. So your weighted average cost of capital is 11.5% standard. Then you are going to discount it for 5 years. And you get this 5 years by taking the difference between the year in which you get the terminal value and the current year. All right. So now, present value of our terminal value is 2063. And then beside our terminal value, here we have 5 other free cash flows we forecasted for the year 2021, then 2022, 2023, 2024, 2025, 2026. So we need to discount all of them back to the current year. That means to the year 2021. All right. So to discount them, we are going to apply the NPV formula. NPV, and our rate is standard every year. We're going to apply this rate over the free cash flow to the firm for the next 5 years. Hit enter. Then value of operation, present value of the terminal value plus present value of the remaining free cash flow to the firm. All right. So this is how we get value of operation. Now let us calculate share price. So value of operations plus our current value of short-term investment will give us estimated total intrinsic value of the firm. So from the total intrinsic value of the firm, we are gonna deduct the market value of debt and market value of preferred stock. In this case, we don't know the market value of debt and market value of preferred stock. So we're going to assume that market value of debt and preferred stock is equal to the book value of preferred stock and debt. So all debt in the current year is your notes payable plus your long-term debt. So this is how you get your all value of all debts. And then preferred stock. Now, total intrinsic value of the equity then is 1,763. Now divide the total intrinsic value of equity by the number of shares outstanding to get share price. All right, so estimated intrinsic share price here is $29.38. Now, let us complete our pro forma financial statement. All right. So remember, to get our free cash flow to the firm, we already forecasted our operating items. That means operating expenses, sales revenues, operating assets, and operating liabilities. So we need to now forecast the remaining income statement and balance sheet accounts to actually complete our pro forma financial statement. All right, so first cash, we already know our cash. Short-term investment, okay. So short-term investment, remember it is non-operating items. So let us copy it from our current financial statements. because it is non-operating item, so we are going to assume it to be 0 in the future years. We don't know how, we cannot certainly estimate this one, and then we are going to always assume them to be 0. Next, accounts receivables, then inventories, then calculate total current assets, then net PPE, total assets is the sum of total current assets and net PPE. Next, accounts payables, we already estimated that. Notes payable, these are non-operating items. So let us copy it from the most current financial statements. Now, we are going to assume that company will continue with the current value in its capital structure. That means the company will not add anything to its debt accounts and then common stock and preferred stock. So these values will remain the same in the forecasted years. The line of credit. So line of credit is the debt account which we are going to use to actually match our total assets equal to total liabilities and owner's equity in the forecasted years. And then we are going to also use special dividends to match both sides of the balance sheet. Okay, so right now our line of credit is 0, but for the forecasted years, that means for the year starting from 2022, we are going to have some line of credits depending on our additional financing need. And we're going to get it from here. Then calculate your total current liabilities. Then long-term debt. $520 in the most recent year, and we are going to assume that it is going to continue for the future time period. Then total liabilities is the sum of current liabilities and long-term liabilities. Then preferred stock, again non-operating items, we're going to get it from the most recent financial statements. We're going to also get common stock from the most recent financial statement. Retained earnings, the same. And then we're going to assume that there will be no changes in the preferred stock and common stock. That means there will be no change in the current capital structure. Retained earnings, so retained earnings is equal to retained earnings in the previous year plus addition to the retained earnings in the current year. In the current year, that means now we're estimating retained earnings in the year 2022. So we are going to consider addition to retained earnings in the year 2022. Then get sum of total common equity, then total liabilities and owner's equity, okay. Now let us check the difference between total assets and total liabilities for the forecasted years. Right. Now let us forecast our income statement. Net sales, then cost of goods sold, depreciation, and other operating expenses. The EBIT, it is net sales minus total operating expenses. Then interest expense, non-operating items. So let us copy it from the most recent financial statement. Now for the forecasted years, we are going to actually forecast them using the interest rate we know for short-term debt and long-term debt. Okay, first for notes, it is average of the notes payables for for this year and for the last year times the interest rate. So our interest rate on short-term debt is 4%. Sorry, 8%. Next, interest on long-term debt, again, average of long-term debt this year and the last year times long-term interest rate. Next, interest on line of credit. For this particular one, we are going to apply interest rate over the beginning balance of the line of credit. Our assumption for this particular chapter will be we actually take new line of credit at the very last day of the current financial year. So whatever line of credit we add in the current financial year, we are not going to accrue any interest on that amount. So we are going to actually pay interest only on the beginning balance of the line of credit. So our beginning balance of line of credit here is 0 times our interest rate. So our interest rate on line of credit is short-term interest rate plus the spread for line of credit. And sum them up to get it total interest expenses. Then pre-tax income, so it is interest expense, and it is EBIT minus total interest expenses. Next, we are going to apply the tax rate. So our tax rate is 25% standard every single year. Next, net income before preferred dividend. then preferred dividend, so our preferred dividend here is $7 for the last years. But for this year, we know our book value of preferred dividend, and then we know our cost of preferred dividend. Then net income, then regular common dividend, for the last year. And then our assumption says our common dividend will grow at a certain rate for the forecasted years. And we have those rates right here. Then for a special dividend, right now we don't have any special dividend, but this is one of the accounts which we are going to use to balance our total assets and total liabilities and owner's equity in the forecasted years. Then addition to retained earnings, it is net income minus sum of regular and special dividends. Right. So now let us calculate our additional financing needed and then how we're going to finance it. First of all, increase in spontaneous liabilities. So our spontaneous liabilities here include accounts payable and then notes payables. Then increase in notes payables, long-term bond, and preferred stock. So here we made a mistake. Let me correct it here. This times this. So our debt and common stock and preferred stock in the current year minus the same accounts in the previous year. So this is the increase. Let me calculate one more time. Here. So as I said, our assumption is the company will continue with its most recent capital structure. So there is no addition, you can see every single year. And then net income minus regular dividend. Net income minus regular dividends. Then previous line of credit. Here. Or previous line of credit. Then increase in financing. equal this plus this plus this minus credit, the increase in total assets, then deficit. Now you can see here in the year 2022, the increase in your total asset is 350, and then you just added additional financing of 200. Your financing increased by 272. So to just meet your current sales growth, and thereby your investment in total assets, you still need to add up $78 million more in your additional financing. So you're going to get that amount through line of credit. Now, if you have additional financing, then you're going to actually pay a special dividend. Now, let us apply the if formula. So if our additional financing need is negative, that means we need additional financing, then we are going to draw this amount in the form of line of credit, otherwise 0. Next, if your additional financing need is positive, that means you have surplus financing, then you are going to pay it off as a special dividend. Now you can see here, in the year 2026, you have additional financing. That you know it by the positive sign of the additional financing, and you actually paid off that amount using the special dividend. Right. So now you can see our pro forma financial statement here is complete. Now we are going to prepare our statement of cash flows. Okay, let us do so. We are going to do it for the forecasted years. You can also do follow the same approach for the current year. That means for the year 2022, exact same approach, but I'm going to do it for the forecasted year here. So we are going to start with net income before preferred dividend. So here you can see net income before preferred dividend. Then we are going to add up our non-cash expenditure, which is depreciation in the forecasted years. Next, increase in operating current assets account will actually reduce your operating cash flows, because in that case you are actually investing, you are spending money. So negative minus increases in accounts receivables, the same way. Positive increase in inventories should be negative, because it is actually reducing your operating cash flows. However, if your operating current liabilities increase, that means you are getting additional financing. So you are getting money. It should increase your operating cash flows. So a positive increase in operating current liabilities should increase your operating cash flow. So the sign should be positive. and sum them up to get your net cash provided by operating activities. In this case, you can see here, for working capital adjustment, we considered only operating current assets and operating current liabilities. Don't consider any non-operating current liabilities and current assets. By non-operating current assets, we mean investment in short-term investments. And then by non-operating current liabilities, we mean all the short-term debt amounts. And then you should not consider cash, because here in the statement of cash flows, you are actually calculating your ending cash balance. So cash account in your current asset side should not be included under your operating activities. All right, next, cash used to acquire fixed assets. So whenever you spend cash to get more fixed asset, you are actually spending money. So the sign should be positive. Whenever you sell your fixed assets, then the sign should be positive. In other words, increase in fixed assets should be your negative financing cash flows. Decrease in fixed assets should be your positive financing cash flows. All right, so to get that, your net PPE plus the depreciation you charged in this year. So this is how you get your gross PPE minus your net PPE in the previous year. So this is how you get your investment in PPE or fixed assets. If you have multiple fixed assets accounts, then you should actually calculate the same for all the fixed assets accounts. Next, now we are gonna consider our investment accounts, short-term or long-term investment accounts right here. In this case, we don't have any long-term investments, but we did have some short-term investment. So let us do it. So again, any increase will be negative cash flows, but any decrease should be positive cash flows. So this minus this. So you can see here, your short-term investment actually reduced from 10 to 0. So in this case, you are going to see, we are going to consider it as positive, as you can see here. All right. Then sum them up. Next, so far here we actually discussed about investing activities. So any investment in your fixed assets or some other short-term and long-term investments should be considered in to calculate your investing cash flows, not financing cash flows. Now we are going to consider the financing activities. So by financing activities, we mean our debt accounts and then our equity accounts, that means preferred stock and common stock accounts, then any dividend we pay. And then if your debt amount accounts or your common equity or preferred stock accounts increase, that means you are getting additional finance. If they reduce, that means you are paying money. The same way, if you pay dividend, that means it should reduce your financing cash flows. Okay. So notes payables. then line of credit, then long-term bonds, then preferred stock, then common stock, then payment of common and preferred dividend. Remember, it should be negative. So here, preferred dividend plus common dividends, including special dividends. Next, changes in common equity. Then sum them up to get your total financing cash flows. Right, now net changes in cash and cash equivalents. So to get it, sum up cash flows from operating activities, cash flows from investment activities, and cash flows from financing activities. Right, so here we made some mistake somewhere. Let us figure it out. This is the problem. So here we did not select the cell from line of credit. We did not select the cell for accruals. Instead, we actually choose the wrong cells, which is for line of credit. So we just corrected it. Now everything looks right. Then equal cash and cash equivalents at the beginning of the year. That means cash balance in the previous year. Let us drag it down. Then equal this plus. Okay, we have something wrong in the very last year. So let us now match 110. So you can see here, your cash balance is 110 in the current year, in the year 2022. Next year, 118.8. So 118.8, you can see. Then 127.1. Then 133.5. But we have problems something here. So let us find it out. Okay, so here is something wrong. Let us see how we get this value. It should be this. So remember, 22-year balance minus 22 1-year balance. Drag it down. Now you see it's right. 140.1. So again, no mistake in terms of the concept, but we just choose the wrong cell. So you also, take precaution whenever you select the cell to get the numbers here. But here the key is your ending cash balance should be equal to your cash balance you reported in your balance sheet. As long as both of them match, your cash flow statement is right. All right. So that's all for this video. In our next video, we are going to calculate additional financing need based on the additional financing need formula. Then we are going to also calculate our sustainable growth rate. Then we are going to run sensitivity and simulation test for our net profit. Thank you.